Hello and welcome to our channel. Today, we are going to talk about a very interesting topic, behavioral finance and the stock market. In this video, we will explain what is behavioral finance, how it affects the stock market, and why it's important for investors to understand it. So, let's get started. Behavioral finance is a field of study that combines psychology and finance to explain how people make financial decisions. It tries to understand how our emotions, biases, and cognitive errors can influence our investment choices. In other words, it tries to explain why we don't always act rationally when it comes to investing. One of the key concepts in behavioral finance is the idea of herd mentality. Herd mentality is when people follow the crowd and make investment decisions based on what others are doing. This can lead to irrational exuberance and bubbles in the stock market. For example, during the dot-com boom in the late 1990s, many investors poured money into internet-based companies, even though they had no earnings or revenue. This behavior was driven by the fear of missing out, FOMO, and the belief that everyone else was doing it. Another important concept in behavioral finance is loss aversion. Loss aversion is when people feel the pain of losses more than the pleasure of gains. This can lead to irrational behavior such as holding on to losing investments for too long or selling winners too early. This behavior is driven by the fear of regret and the desire to avoid taking a loss. Finally, we have confirmation bias. Confirmation bias is when people look for information that confirms their pre-existing beliefs and ignore information that contradicts them. This can lead to overconfidence and a false sense of security in their investment decisions. So, how does behavioral finance affect the stock market? Well, when people act irrationally, it can lead to volatility and inefficiencies in the market. For example, during a market crash, many investors panic and sell their shares, which can cause prices to fall even further. Conversely, during a bull market, investors may become overconfident and continue to invest in overvalued stocks, leading to a bubble. If you want to be a successful investor, it's important to understand how behavioral finance affects the stock market. By recognizing your own biases and emotions, you can make better investment decisions and avoid common pitfalls. We hope you enjoyed this video and learned something new. If you did, please hit the like button and subscribe to our channel for more informative videos on finance and investing. Thank you for watching, and we'll see you in the next one.